Hey folks, welcome back to the channel. It's Liquid here, and a few weeks ago, right around here, I made a video explaining why I think the S&P 500 is probably in a topping process, and it's likely we're going to see a pullback or a correction soon, which is why I put in a bearish trade using options, selling some call spreads, and as it turned out, the market did close below my strike, and I was able to make some profit there. But since then, a lot of things have changed. So today, I just want to quickly talk about what I'm seeing in the market and what to look for in the coming weeks. Now, for the past few months, I mentioned pretty much every technical video that I was bullish, simply because the stock market has been in this blue bull channel and going up. But since we got the negative divergence here in the RSI, where the RSI made a lower high from this point to this point, but the S&P 500 made a higher high, there was a good chance that the market was going to turn. And I was keeping an eye on the bottom of this channel, because if it broke through, which now we know it did, then that could be the start of a new bearish trend going down instead of up. So if I'm looking at short to medium term trades, maybe from a couple weeks to a couple months, I would be looking at bearish trades right now. So either buying put options, selling call spreads, anything like that. And there's a few reasons why I think the market has changed. Reason number one is to take a look at the oscillators. On the relative strength index, you can see we are below the 50 line. It's currently at 38.69, which is not in oversold territory yet, but the momentum is certainly going that way. For the MACD, similar story. The blue line is below the midpoint on the daily chart, and it's also diverging away from the orange signal line, which indicates bearish sentiment. So it's most likely going to continue going that way. As you can see previously, over here where the MACD went negative, and you had the blue line and the orange line continued to go down for several more days. And that's not a good sign for the stock market. And as you can see here, the market went down. And finally, we have WNR, which is also based on momentum. And right now it's below -80. And when that happens, the market tends to go down. The second reason it looks like the market has further to fall is based on the price action. If we follow channel rules, we know that when the price breaks a channel, in this case it breaks it to the downside, we can wait for a back test, and if it goes back into the channel, then there's a chance it'll continue going up. But if it hits the bottom of the channel and gets rejected, then that is a bearish signal, and that's what happened. So the market went up to retest, and the retest failed, and now it's closing back down. The moving average also tells us the same story. Let's use the 21 EMA for example, which is the blue line. And the longer the moving average you use, the more accurate your trades will be. But at the same time, you'll also be missing out on more of the gains. But we'll just use the 21 blue line for now. And we can see that for the most part, during the last few months, the market has stayed above the blue EMA, except on May 30th, where it closed below, but then the next day it bounced right back up. So there was no confirmation for this. Same thing on July 19th. The market closed below the blue line, but then the next day it bounced up. So really, it wasn't until on July 24th, where the market closed below the blue line, where we got a confirmation where it also closed below the line. So this might be something substantial. So let's wait for a retest. And it went back up, and it went above the 21 here. So, okay, if the next day is green again, then I would still be bullish, but that's not what happened. As we can see, the market closed back down. So there was no confirmation after this one day. And not only did the market close below the blue line again, but then the next day, we got confirmation because this candle also closed lower. And to further drive the idea home that we're bearish now, this last session, it closed below the previous low, which is another indicator that in the next couple months, it's more likely for the stock market to continue falling because this officially now has made a lower low. And we know that from the previous day, which it made a high, is lower than the previous high. So we have lower highs here and we have lower lows, which makes a trend. And in this case, the trend is going to be bearish. Now, in the previous dip, that didn't happen, which is why it would be a mistake to be bearish during this March-April pullback, because although the market fell below the 21 EMA, went back, did a retest, bounced off of the blue EMA, it did not make a new low. It actually just stopped right here, which is higher than the previous low. In fact, when it bounced back up from this level, it went up and surpassed the previous recent high and continued going higher. So if anything, this would be a reason to go bullish, because instead of lower highs and lower lows, like what we have this time, back then, the market made a higher low and also a higher high. So I would wait for the market to close on a higher high and then wait for a confirmation, which is the next day. And I would have gone in with a bullish trade on the next day, which was May the 7th. So unlike this previous pattern, the market did not make a lower high. Instead, it made a lower low and a lower high, which is why I'm leaning towards bearish for now. And finally, if we look at the price action from June 13th until now, it kind of makes a head and shoulders pattern. And we got confirmation of that this past Friday when it fell through the neckline. So typically how it plays out is we have a left shoulder that is lower than the head, and then we have a right shoulder that is also lower than the head. And each time when they come down, they hit this support, which is called the neckline, and you want to go short when it breaks that neckline. And as you can see, that's exactly what happened on Friday. If you want to be like really safe, you would wait for a back test. And if it hits the neckline and bounces off of that, that trade is safer than going short right now, which is why I'm going to wait and see if there's a relief rally in this upcoming week. And if that happens, I'll pay attention to where it peaks out. Now, buying puts is one way to take advantage of a declining market, but there are other hedges you can add to your portfolio. For example, last week I talked about TLT, the long-term treasury fund, and I mentioned how that should do well if the economy gets worse, which is the opposite of what the stock market would do. And since I put out that TLT video on Tuesday last week, the stock market has been down. Meanwhile, TLT is up about 4.7%. Now, it's likely we'll get a pullback from here. As you can see previously, when there's a hyperbolic move up, TLT usually has a correction. And in the previous cases here, it was in a downward bear channel, which is why each new high was a lower high. However, I think this time is going to be different because we're seeing higher lows. So I think this could be the beginning of higher highs to come. Anyway, I'll link that video here if you're curious about TLT. But that's going to do it for now. Thanks a lot for watching. Good luck with your investments, and until next time.